Before you FOMO into Wolfspeed, ticker WOLF, the stock that just jumped 1,800% after emerging from bankruptcy, you need to see this one chart. The incredible debt cut came at a brutal cost to shareholders, and its core business is still facing a massive threat. Is this the comeback story of the decade or the ultimate value trap?
At Wolfspeed, it's our job to make humankind's greatest ambitions real.
Welcome back. Wolfspeed is the new face of silicon carbide, SiC, the future of high-power chips. But this is not a normal stock. They filed for bankruptcy after their liabilities spiraled to $7 billion, despite being the leader in next-gen tech. Today, we're doing a deep dive to see if the new Wolfspeed is a buy.
To understand the risk here, we have to remember the history of high-tech manufacturing. Look at the story of Sun Edison, a solar company that, much like Wolfspeed, was built on world-changing technology. They had the right mission, but they ignored their growing $16 billion debt mountain until it was too late. When they eventually failed, the shareholders were wiped out, even as the core assets continued operating under a new name. This is the central conflict in Wolf, the battle between game-changing technology and a balance sheet that can destroy it all. The new Wolfspeed has fixed the debt, but can it avoid the Sun Edison fate of poor execution? Let's get straight into the financial surgery. The spike isn't a profit story, it's a balance sheet story. Wolfspeed was drowning in $7 billion in debt. To fix it, they executed a drastic debt-for-equity swap. They essentially told creditors, "We can't pay you, so here are shares instead." This cut the debt by 70%. But here is the brutal consequence for you, the old shareholder: extreme dilution. Your old ownership slice was crushed as billions of new shares were issued to those creditors. The stock price looks like a gain, but your ownership stake was minimized. That history is why this stock is a battleground. Now let's pivot and ask, what is the actual technology that makes people ignore this financial bloodbath? The core concept is silicon carbide. Think of your old chips as a leaky pipe, wasting energy as heat. Silicon carbide is the hyper-efficient superhighway for electricity. It handles 10 times the voltage and operates at much higher temperatures than traditional silicon. This efficiency is the non-negotiable requirement for two massive industries. The first industry is electric vehicles, EVs. An EV inverter uses SiC chips to convert the battery's power to drive the motor. By using Wolfspeed's SiC, an EV can gain up to 10% more range without adding a single battery cell. That's why every major auto manufacturer, from Tesla to the German giants, is frantically securing SiC supply. Wolfspeed has locked in a multi-billion-dollar backlog of orders for their power modules. This backlog proves the demand is real, massive, and sticky. The second driver is industrial infrastructure. Think of massive data centers and the new grid infrastructure needed to handle all that renewable energy. Silicon carbide chips enable smaller, more efficient, and faster charging systems for everything from solar farms to server power supplies. If the world is going to decarbonize and run on massive computing power, it needs SiC. This market is slower than EV, but potentially more lucrative long-term because it touches every industrial upgrade globally. The debt is cut and the demand is enormous. That's the bull case. But here is the elephant in the fab: execution. Wolfspeed is making a massive multi-billion-dollar bet on next-generation 200mm wafers. This is their biggest advantage, but also their biggest financial burden. In the next act, we'll dive into Pillar 1, the factory bet, and whether they can actually execute on this complex manufacturing shift before they run out of cash.
Wolfspeed is going all in on 200mm wafers. They opened Mohawk Valley and are building Siler City. Why is 200mm crucial? It's a massive scale play. Making a larger wafer dramatically lowers the cost per chip. The issue? They are still running at low utilization, meaning they are paying high fixed costs while revenues haven't caught up. Data shows they still have negative gross margins. Financial debt is gone, but the operational debt remains. They must rapidly improve their manufacturing yield, the percentage of good chips from a wafer. This is not easy with silicon carbide. Poor yield is the core reason for the negative gross margin. The CEO's job is to prove they can move from being a leader in R&D to a leader in mass production. We need to see consistent quarter-over-quarter gross margin improvement for this to be a true comeback. So, what's the verdict? Wolfspeed is a high-conviction bet on a future technology, now with a cleaner balance sheet. But the stock remains a speculation on execution. It's only a buy if you believe management can solve the 200mm yield problem in the next 12 to 18 months. If they do, the $5 billion backlog makes the current valuation look tiny. If they fail, the company burns cash until the next capital raise. Wolfspeed is a high-stakes way to play the SiC space. Are there better, less dramatic plays? Yes, but that's a story for another time. This was the full breakdown on Wolf. Don't forget to subscribe to track our next big analysis. Thanks for watching, and I'll see you in the next one.